My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll do it, my friends. I'm just trying to make a little money. My job is not just to entertain, but to educate and teach. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Roaring job numbers. Not so roaring kitty. What can I say? This economy is creating jobs like there's no tomorrow. You'd think we've already had multiple rate cuts rather than none. And yet investors seem to think that the labor report didn't matter all that much, even as higher rates were right on its heels. I mean, the job growth almost seemed more reassuring than worrisome, which is why I think the average has barely got dinged. Dow slipping 87 points, S&P edging down 0.11%, NASDAQ declining 0.23%. Look, this one could have been a disaster, people, given how interest rates flew up on the news. It wasn't. Oh, and as for Roaring Kitty, you could tell that Wall Street turned up its nose in disdain. You knew they would do that. Yeah, Wall Street wanted some sort of real show. If you watch it, all I can say, sightseers, is not what you pay for. So what's on tap for next week? Well, let's just go over here. Take a look. All right, look at this. Look at this Monday. It's an unbelievable day. It was supposed to be like a middle June. Nothing's supposed to be happening. No Sleepy Monday here. We have three important events for three of the biggest companies on Earth, and that's Apple, NVIDIA, and Lilly. Apple kicks off its annual Worldwide Developers Conference, and while it's rarely newsworthy, this time could be different because we might get some insight into what's going on for both the Vision Pro and the iPhone 16. Our goal is to figure out how many people are writing important programs for Apple products. I know it's a tad pedestrian for us consumers, which is why the conference rarely causes stocks to run. But because we keep hearing that Apple's behind on AI, maybe they show us something that shoots down that negative narrative. As for the Vision Pro, we need to see if developers are trying to do anything special with it. Otherwise, people will give up on the idea that it's anything more than a niche product. I think Vision Pro can still be used, especially when it comes to building complex structures, designing pretty much anything. My mantra has not changed. Own Apple. Don't trade it. As for NVIDIA, we're getting a 10-for-1 split. Yeah, my experience is when you get a 10-for-1, by the way, you tend to take people tend to take profits on a couple of them and let the rest run. So that's enough profit taking temporarily to overwhelm the buyers. So don't be down if NVIDIA gets hit on Monday after the split. It's just the psychology of the event. I'll keep 7, I'll sell 3. Own it, don't trade it. All right, now how about Eli Lilly? Very confusing story here. An FDA advisory panel will consider its Alzheimer's drug on Monday. I bet they'll be favorably disposed. Journalists have been writing and talking about this document that the FDA released yesterday about their Alzheimer's drug, saying that it presented a very narrow view of the drug's use. Total misread of the situation. The document said the drug looked to be safe and effective. I think that sounds pretty positive to me, so I expect good news from the panel. That said, we won't find out anything until the market closes. The panel's supposed to go till 5. Still, I have a positive read on the situation. I think this Alzheimer's drug could be huge if it gets approved, but nothing near term. Hey, by the way, we own Apple, NVIDIA, and Lilly for the Charitable Trust, so if you want more in-depth coverage, we're going to be covering wall to wall, as they say, for members of the CNBC Investing Club. Next, Oracle reports after the close on Tuesday. Let's call it a conundrum, all right? Because Oracle's spending billions of dollars to build out data centers, and Wall Street's reaction has been, let's say, schizophrenic. Last time they told a story of aggressive data center growth, and it was well received. Previous 2 quarters, they said the same thing, and it was poorly received. I think they can talk about going all out, and the stock will go higher. But we need to start rethinking about Oracle's $28 billion acquisition of Cerner 2 years ago. This electronic health records business hasn't been doing too well under Oracle. My sources say that Epic, a private competitor, is winning lots of business I know I was hoping it would go to Cerner. I am wary about any questions about Cerner on the conference call. Now, here's one that makes a ton of sense that doesn't usually pop up in the minds of New York and Wall Street people. Casey's General Store. Why this thing? I know it just sounds like another, like a 7-Eleven or something. Au contraire. It's got a secret weapon, a breakfast pizza that remains incredibly popular. Don't worry, it's eaten all day. But who doesn't want a bacon, egg, and cheese pizza for breakfast, or for lunch, or for dinner? I'm not kidding. It's been a home run for this 2,600 store chain that's in 17 states that most of the people in New York have never been to. Stock's been a total winner. Wednesday's huge. first we get the consumer price index, and in light of today's report, I got to tell you, the CPI is probably going to come in way too hot, makes things tough for the Fed. Then we'll hear firsthand when Jay Powell speaks at the conclusion of the Fed meeting later on Wednesday. He's going to still do that ridiculous Q&A, too. I hate that. I know that we've had some brown shoots, and I've reported them on you. Those are signs of weakness to make it easier for the Fed to cut rates. But with this extremely strong employment number we got just this morning, I believe the Fed will have no choice but to leave rates higher for longer. That said, both the economy and the stock market have done well with the current regimen. So I'm pretty, I guess you could say I'm feeling pretty sanguine about higher for longer. I'd love a rate cut like you, but not at the expense of persistent inflation. And by the way, that's how you should feel. We want persistent inflation to be stopped. After close Wednesday, Broadcom reports AVGO, and I'm looking for a big number for this charitable trust holding. Now, Broadcom has a huge AI component, as their network equipment is essential for all these data centers, but they also have this other more prosaic aspect of its business, which is wireless. And that's just been doing okay. If the latter were improved, then this stock could just take off from here. Otherwise, Broadcom's a really good situation, but not a great situation because they still have this major part of their business that's just not doing that well. Okay, now, Thursday morning, we hear from Signet Jewelers, and the last time it reported, the stock got crushed, even though their numbers weren't even that bad at all. Then it came right back. That puts us on notice. If Signet gets hit again, we might want to buy it. I really like CEO Gina Drosos and what she's been building. If it gets hit like that, bring it in. At the close, oh boy, is this a tough one, Adobe reports. Now, we've got a highly unusual situation here, as the stock's down 22% for the year going into the quarter. Down. This is an amazing company. I think Adobe's got a problem, though, and that's competition from a design tool company it tried to buy called Figma. Adobe needs to protect its price points against Figma, which is a price cutter. But Figma's taking share because its software is so much less expensive. I know Adobe's so much more than just this one product line, but the Figma competition is what controls the narrative. It shouldn't. I say never count out Adobe. We also get results from RH, and that's the artist formerly known as Restoration Hardware. And last quarter seemed like a breakout after a prolonged period of disappointment. Stock shot up huge, but then it came down hard almost immediately. What will it take for RH to get out of this rut that it's in? As great as their products are, we know this business is levered to housing turnover, and we don't have much in this country. Probably the least we've ever had. I mean, I'm not kidding, in modern times. So my prediction, there won't be much upside for RH until the housing turnover number increases. Finally, on Friday, a firm hosts a fireside chat, and I bring this up because this buy now, pay later company, I think, is doing incredibly well. But it hasn't mattered to the stock lately because big institutional investors have no interest in financial technology when interest rates are so high and less wealthy consumers feel so cash-strapped. I think the stock should be going higher, but I know the big money guys can't get comfortable with it. A firm stays right here, no matter what they say. Wow. Bottom line, I'd be careful making a big move before the Fed meeting. We can't be sure if Jay Powell won't be more emphatic about leaving rates higher for longer, given this morning's hotter-than-expected jobs report. So next week, lots to chew on, but not enough to pull the trigger. Except for maybe that Lily. Anyway, John in Washington. John.
Booyah, Jimmy Chill.
Hey, how you doing?
I'm doing good. Jim, Rivian stock price has been fluctuating since its IPO. Where are you anticipating it heading in the next 6 months, let's say, towards the end of 2024?
Okay, Rivian needs to have... They need to find some way to get a lot of money in without causing too much dilution, and I don't know how they do that. But I've got to tell you that I think that the decision to not spend all that money in Georgia was a wise one, and I think that it's got popular enough cars that something can happen there. But right now, they need more money. Let's go to Robert in New York, please. Robert.
Hey, Jim, I just want to say, you know why your show is top in the country and around the world? It's only one reason. It's because you do your homework. And that's why you make everybody money. You do your homework.
Well, I try to make people money. You know, I make mistakes too, but thank you. You're very kind. Thank you for that.
Let me tell you, mistakes. You've given maybe a stock here that's been flat. That's not a mistake because I didn't lose. So you may make a mistake, but not too bad. I gotta say.
Thank you. That's very kind. That's very, very kind. Thank you.
Thank you, Jim. But you were very positive on this company on the morning of January 31st. And if everyone listened to you like I did on that day, they would be sitting on a return of over 28%. JP Morgan has this stock as an overweight at $650 a share. They have over 270 million, Jim, paid subscribers and building. And it's over $648 a share. It's Netflix. What do you think we should do?
Oh, I like Netflix very much. I'm just convinced that they know how to make the great products that we want for the least amount of money. That's what it's about. They've done it right. Other people just don't seem to understand how good that situation is. And by the way, just before we go into the rest of the show, I want to congratulate George Kurtz for CrowdStrike joining the S&P 500. That stock, which went out at 350, will be up substantially on Monday. All right, look, I'd be careful making a move before the Fed meeting because we're just not sure how emphatic Jay Powell will be about leaving rates higher for longer, given that red-hot jobs number that we got today. Well, man, buddy, tonight, Medtronic stock has had some mixed action since its earnings beat last month. I'm going to catch up with the CEO to see what's ahead for this healthcare name. Then, the maker of Uncrustables, dirt cheap, and Goldfish, I like the cheddar, both important this week. I'm seeing if you should keep some packaged food plays in your cart amid a questionable economic backdrop. And you called in on 2 small-cap industrial stocks. I'm turning my homework, and I got to tell you, one of them, woo, really exciting. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
2 weeks ago, we got robust results from Medtronic, the big medical device maker, but because their guidance for the current quarter came in a little light, stock dropped more than 5% response. Since then, it's recovered the bulk of the losses, and I think Wall Street just doesn't give this company enough credit for being a great innovator, and I mean great. But don't take it from me. Earlier today, we got a chance to speak with Jeff Martha. He's the chairman and CEO of Medtronic. Take a look at this. Mr. Martha, welcome back to Mad Money.
Jim, good to be here. Good to see you again.
Excellent. Now, Jeff, last time we were waiting, and now we've seen the approval of what may be the first breakthrough device for chronic pain. And you got to tell us about this, because this is probably one of the most dangerous areas in terms of what's happened in our country and how people handle pain. And you could have an answer to it.
Well, yeah, thanks, Jim. We were really excited about this. The product's called Inceptiv. It just got approved in late April. And what is so special about this? This is in the category of neuromodulation, where we stimulate, whether it be structures in the brain for conditions like Parkinson's, or in this case, your spinal cord to control pain, particularly back pain and leg pain. And what's so unique now in the field of neuromodulation is we can sense as well as provide therapy. So it's closed loop. We listen and we talk, and we can customize the therapy for the patient. So in the case of pain, what we're really excited about, we're actually adjusting the therapy 50 times a second. So as you move around, just imagine your back pain changes as you're walking, running, jumping, lying down, and we can adjust that therapy real time, 50 times a second. And really customize the therapy for the patient in the moment. And that's why we're so excited about it.
All right, so, Jeff, let me ask you. Right now, the treatment is kind of really antediluvian. For instance, I take a huge amount of Lyrica every day for exactly what you were talking about. Can I get off Lyrica, which we know is obviously, it's a generic drug, but it's 17 million people are supposed to be taking that drug. Can we get off that and take something that you have?
Well, look, we definitely think medical devices in many different areas are allowing patients to dial back their medications and really put a medical device into their therapy regimen. And as you know, medical devices are specific engineered solutions that in many cases don't have the same side effects that you get from oral medication. And so, yeah, I definitely think, for these type of patients, by in putting this type of therapy into their life, you can really put the pain in the background. And the other thing about it is the device is really small. It's the thinnest closed loop pain stimulator on the market. You can really just put it in the background, not think about it, and it's working 24 hours a day, 7 days a week, adjusting pain therapy 50 times a second. So yes, you should be able to live a much healthier and happier life with this.
Well, I wish the analysts would understand how big this is. I think this is the first real, multi-billion-dollar blockbuster you guys have had, and yet the stock is kind of flatlining. Maybe there's just not enough awareness about what your device is?
Well, I think there's an awareness. It's an opportunity. And look, Jim, we're in the early innings of launching a number of products into very big patient pools that have a high need and big growth potential, whether it be AFib, atrial fibrillation, whether it be hypertension. In the neuromodulation space, we just talked about deep brain stimulation and pain, spinal cord stimulation for pain, surgical robotics, and then of course diabetes, our closed loop system there. We launched new and novel technologies in all these areas, and I think, Jim, we just got to translate this technology and this clinical benefit into profitable revenue growth. And as we do that, I think shareholders would take notice. Well,
let's talk about another one, the transcatheter aortic valve. This was approved in March. Already you must have some sense about how big the TAVR system is.
Oh, yeah. Look, this is a multi-billion-dollar market. Medtronic's one of the two leaders in this space, and we've been, gaining share here because of the product improvements and the clinical data. We just had clinical data released just a couple of weeks ago called the SMART trial, where we went head-to-head with our competitor on what they call, small annulus patients, which tend to be women. And we had clear clinical benefits that show our valve, the improvements that we made in our valve, are better for women. And what was unique about this study, it was one of the first studies of its kind where almost 90% of the patients in the clinical trial were women. Women are an understudied group in healthcare. And there's a lot of excitement around that trial, the results, and what this transcatheter valve is going to do to this big patient base of women who are suffering from aortic stenosis.
And you guys have such a great reputation for exactly where you're working there. Now, the lasting simplicity spiral, the hypertension, I'm still waiting for doctors to be able to say, look, this is the preferred way, particularly for people who are obese and for people who don't think they have anything wrong. How do you get the word out about that? Right. Because that's the patient population that is causing that. It's just so painful because these people have something and they don't think they need it.
Right. Well, this is another case, Jim, where the medication is a standard care. These hypertension patients are on 5, 6, 7 drugs, and there's a lot of side effects, and they tend not to take them because of the side effects, and they can't control their hypertension. So here we come with a catheter-based solution. It's a procedure, under an hour, one-time procedure, and you're done. You don't need to go back. We've got thousands and thousands of patients that have gone through this around the world, a diverse set of patients, and years of follow-up data. We're seeing typically double-digit drops in hypertension, which is massive with really no side effect profile. It's super safe. So now what we're waiting on is more broad covered reimbursement. And as that happens, the awareness we'll pair that with some more awareness on this. But the reimbursement, you can get this therapy today in the United States. It's FDA approved, a breakthrough medical device. Patients are getting it. But the reimbursement isn't out as broadly, it's not broadly out there yet. That will happen here, we expect, of the coming months and year. And in the meantime, we'll start driving awareness. You're going to start to see hypertension clinics pop up around the country, whereas before this was managed out by primary care with medication and not very effectively. You're going to see big centers and cities putting together these hypertension clinics.
I asked for it, Jeff, and my doctor said, you're on a generic drug. It's real good. You take it. What's the worry? And I said, well, the worry is that I have my blood pressure. Every time I take it, it's variable. Sometimes it's way too high. I want this consistent. And he said, no, the system is not going to support Medtronic. The system is supporting the generic drug. What is it? Who is the system that keeps me from getting what I want?
Well, look, that's something that, over the years, Medtronic has shown a history of what they call developing these markets, developing them based on the efficacy of the product, the clinical data that supports it, and the health economics that shows that it's good for the system. It's a good investment for the U.S. healthcare system and other systems around the world to make, and that leads to reimbursement. So as we are, maybe 75% of the way through that continuum, we've got the FDA approval, we've got the health economics, and now we're working with different payers around the country, including CMS, to get coverage. And as that comes in, the system, as you call it, will start to work in a way that you want it to, and that'll be more accessible. This groundbreaking therapy will be much more.
Well, look, it is vital that you win on these, Jeff. It really is. It's vital for the country. It's vital for the system, for whatever the system really is. But you save a lot of lives, and I think your stock is just so radically undervalued. But I think that what's happened is the medical system has to catch up with what you're doing, and when it does, then I think the stock is going to go like a rocket because you have too much good stuff. And that's how I'm positioning my view on Medtronic. And it's a lot of your just great work since you've come in. So I want to congratulate you, Jeff, because what you're doing is really breakthrough on many different fronts. Thank you so much for coming on Mad Money.
Well, thanks, Jim.
Of course. That's Jeff Martha, Chairman and CEO of Medtronic. Guys, I've spent a lot of time analyzing what they have in the pipeline and what they have been approved. And it's really much bigger than what the stock is reflecting. Just take a hard look at Medtronic. It's a great conservative company to begin with, but they have a lot of breakthrough stuff. Stay with Mad Money. Lately, we've been seeing more and more brown shoots, signs that parts of the economy are slowing. Look, even if today's labor report definitely wasn't one of them. Still, we've had enough signs of weakness that it might be a good idea to own some recession stocks, the stocks of companies that make the same money in good times and bad, because their products are essential. For example, the packaged food plays. This week, we got results from two packaged food companies that I've followed for ages, Campbell Soup and J.M. Smucker. So it's worth going through what they had to say because I think they both told a compelling story. Why don't we start with Campbell Soup because CEO Mark Clouse came on last night. Back on Wednesday, this company reported a seemingly confusing quarter with solid results, but management also gave us some not-so-hot guidance. In this case, some of the confusion is from the acquisition of Sovos Brands, and that's the parent of Rao's. It would have been easier, of course, if it had just been called Rao's. That's all we talked about. And this pasta sauce, and also some other popular Italian food products. Campbell Soup closed on the deal in March, so this was the first time that they incorporated Sovos into the full-year forecast. And that caused a modest hit to the organic sales growth and earnings outlook because, well, see, the deal's slightly expensive up front. Over time, though, I think it'll pay for itself. But Wall Street was confused about how much of the guidance cut was from actual weakness and how much was related to the Sovos acquisition. Then on the conference call, Mark Clouse warned that the snacks business is now facing, and I'm quoting here, some short-term pressure, especially among lower and middle-income consumers. Now, that freaked people out entirely because even as his next sentence was much more positive, quote, we are seeing some modest improvement in the snacking segment in the most recent weeks with the expectation of more of a full recovery in the first half of fiscal 2025, end quote. So Campbell Soup is actually optimistic on the near-term future of snacking, which is important because they have some huge snack food brands. When we had Klaus on the show yesterday, he gave us some clarity on both these issues. I got to tell you, I thought he was much better on our show than he was at the conference call. Why don't we start with the snacking worries? Listen to this.
When I think about the role of snacking, and I think about what we have now built in this transformed portfolio, right? 50% of the business is snacks. I see no structural problem. Okay. I expect this to be outsized growth.
See, that was so much more clear. It made me feel so much more bullish in the call. Klaus also sounded extremely bullish on the Sovos brand edition, saying, I've done quite a few acquisitions over the years, and I have to say, really, across the board, this integration is going fantastically. The business grew 27% in the quarter. We were neutral on EPS. How many times have you seen a big-scale integration have no dilution in the first quarter of the business? And when you put it together with Campbell's on a pro forma basis, the total company would have grown collectively 2%, and our meals and beverage division would have been up 5%, end quote. Okay, so that's just a much better story than I heard on the conference call. It's huge. So I think worrying about the earnings hit of a penny or two from Sovos, and again, Sovos is Rao's, is in the current quarter is incredibly short-sighted because this thing's going gangbusters. Now, there were other positives, too, with Klaus explaining that Campbell's demonstrated an ability to grow sales with higher volumes, not price increases. That's important, right? Because we know price increases aren't sticky anymore, while also improving its margins, again, without the benefit of higher pricing. After speaking with Klaus last night, I feel much, much better about this Campbell Soup story. That doesn't hurt. Stock's cheap, 14 times forward earnings. Solid yield, 3.45%. You've got my blessing. If you want to own Campbell's, I say yes. How about Smucker? Okay. Now, they reported yesterday morning. Remember, Smucker was the poster child for the great GLP-1 weight loss drug scare last fall because, well, they bought Hostess. And best known for its iconic junk food like Twinkies and Ding Dongs, right as we were adjusting to the brand new world that is Ozempic and Mounjaro. Unlike most other packaged food stocks, this stock really hadn't recovered going into the conference. In fact, it had just set a new 52-week low last week. But Smucker actually turned in a solid set of numbers yesterday morning, and they told an even better story at the conference call. Their sales were a little softer than expected, but the company earned $2.66. Wall Street was only looking for $2.35. Smucker also offered good enough guidance for the 2025 fiscal year, which ends next April. They're talking 9.5 to 10.5% sales growth. That's not bad. Analysts were looking for 9.7. Although the midpoint of their earnings forecast was $10 when the street was looking for $10.18. Still, putting it all together, it was enough to propel the stock from $110 to $115 yesterday, oversold. Some of Smucker's brands are doing very well here. Management called out the strength of Uncrustable sandwiches, up 17% year over year, doing well both at home and abroad. They have a very low price point, by the way, and that's what I think is doing well for them. Their pet food business grew at a double-digit clip after the company recently sold off some non-core brands. Their coffee division more of a wash with some brands strong. Folgers was weak. As for Smucker's newest segment, sweet baked snacks, meaning the former Hostess business, came in a little light, even as management said the integration is going well. So, like with Campbell's, I call the Smucker results solid. They're certainly not spectacular. But for one of the most hated stocks in the group, no, one of the most hated stocks in the entire market, solid was good enough. Looking forward, I still think the Hostess deal was a mistake. And well, at least in terms of how much they paid. I also think that management needs to turn around the coffee situation. That said, there's a terrific value case to be made for Smucker. This darn thing sells for 11.4 times its forward earnings estimates. That is 3 turns lower than its average historical multiple. Numbers usually sell much higher. Plus, Smucker pays you a 3.7% dividend yield. Now, that's something that will get more attractive if interest rates come down later this year. I'm still expecting them to come down, but not aggressively. Ultimately, I feel incrementally more positive on the packaged food space after hearing from Campbell's and Smucker's. For those two stocks specifically, I do prefer Campbell's. Sovos acquisition, much better than the Hostess acquisition, and really playing, by the way, well overseas. Smucker still has a good value proposition now. However, there are many other packaged food stocks that I like. For example, the protein plays, Tyson Foods, up 16% since I turned positive on it in November. I even endorsed Hormel. I mean, it got hit with a nearly 10% sell-off after it reported last week because the Hormel quarter was beset by one-time issues like manufacturing hiccups. I think that the decline was overblown. I thought that they told a really good story when they came on Mad Money. I would be a buyer. What else? General Mills may be the most consistent operator in the sector. ConAgra Brands has a strong business in frozen foods, very popular with millennials, Gen Z. And if you believe Campbell's Mark Klaus that this cooler period for snacks is temporary, then you might actually want to consider Kellanova, the snack food-focused progeny of the old Kellogg, which completed its breakup last year. So let me give you the bottom line on this group. If you think we're headed for a slower economy, as many people do, then you need some packaged foods exposure. And we just heard some encouraging things from Campbell's Soup and Smucker. These are both decent options. Campbell's Soup is the more go-to name. Don't forget Tyson, Hormel, General Mills, ConAgra, and Kellanova, because the whole group works in a slowdown, and it always has. Why don't we take some calls? Let's go to Mike in Connecticut. Mike.
Hi, Jim. How are you?
All right. I'm good, Mike. How about you?
Great, great. Every time I call, I can't help but say thanks for all the good years of teachings. You know, they've netted me a lot of money and a lot of wisdom.
Thank you, buddy. Thank you. A good way to end the week with some nice comments that I can go tell my wife when I get home. What's going on?
All right. I'm in my 70s now, and I just hold 4 to 6 stocks at one time. One of the stocks I treated as you treated Apple over the years. The stock is McDonald's. Since the late 80s, I've been buying up it, and I did this because the stock was so iconic. Every time it was broken, someone would swoop in and fix it. Not to mention the great dividends and the splits over the years made it very compelling. 2 summers ago, I started selling it off. I sold 400 shares because it's not been progressing like it was in the past. I still hold 300 shares. My thought is I should sell them and then start buying up Chipotle maybe.
Okay, let me give you 2 views on this. One is that you're right. McDonald's is not doing what I thought. They charge too much. They've not rolled back prices enough. They seem to have unruly franchisees who don't want to go with them, and they don't come on air and tell us what the hell's going on. That's not acceptable to me. That's not the McDonald's that I want. Secondly, though, Chipotle, I think Chipotle's great. You got a big split coming up. There's some people who are still concerned that they still believe, and it's really from TikTok, that they made the stuff smaller. Brian Nickel came on the show and said they didn't make it smaller. I'm going with Nickel over TikTok. I think that there's going to be a lot of stock coming from that split, and you don't want to buy it ahead of it. You want to wait. Okay, anyway, thank you for those kind comments. When it comes down to the two packaged food stocks that reported this week, I'm leaning towards Campbell's over Smucker. But the entire space is intriguing, well, if you think there's going to be a slowdown there. Now, much more mad money. I'm seeing if Forward Air and Great Lakes Dredging and Dock are worth putting your money in. Then I'm giving you my take on the Wall Street and Washington mindsets after May's stronger than expected jobs report. And, of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Every time you call in with a stock that I don't know, I promise to take a look at it, then circle back. Today I've got two of them, two tiny companies that are barely large enough to mention on air. So before I get into specifics, I need you to understand that anything this small is inherently very risky, especially in the past year, where small caps have been insanely volatile. And that's why I always say that when you speculate on tiny companies, you should only use money that you can afford to lose, because it's entirely possible to lose everything, okay? But this is Speculation Friday, so let me walk you through them, and they're both pretty exciting. The first one a little better than the second. Let's start with the first one. This Great Lakes Dredge and Dock, which Matt in Massachusetts asked me about on Tuesday of last week, and I was pretty stumped. As the name suggests, the company's a leading provider of dredging services in the United States, although it mostly operates off the coast now. About a third of the business comes from capital projects. Think port deepenings, expansion projects, coastal restoration, land reclamation efforts, and liquefied natural gas terminals. Another third comes from coastal protection work, and the final third comes from maintenance work, with a smattering of work in rivers and lakes rounding things out. You know, all this stuff is in play. Great Lakes is the leader in the dredging market with the largest number of dredgers and a 33% market share. The next closest competitor is only at 20%. This is a company that's been publicly traded for nearly 20 years. You know, this thing came public at the end of 2006 by merging with a SPAC. Yeah, we've had them back then. But over the long run, the stock, well, frankly, it hasn't done anything. It's been effectively range-bound for almost 2 decades. And when you look at the long-term sales and earnings numbers, that makes sense, as there's no clear direction in the numbers, and there's certainly no sustained growth. They're not even consistently profitable. Over the past 10 years, they've been profitable in only 6 of them, although in the company's defense, that includes 5 of the last 6 years. I kind of like that. Buy. But here's why I'm really interested in Great Lakes Dredge and Dock. The company should benefit from the federal government's continued massive infrastructure spending. The bipartisan infrastructure bill from 2022 includes billions to improve ports and restore coastlines. Plus, that bridge collapse in Baltimore, let's call that a wake-up call for every port in America. Beyond government spending, Great Lakes has a couple of other tailwinds, including the build-out of the LNG facilities and the construction of offshore wind projects. Now, I love the LNG theme, but I'm less excited about the offshore wind theme. And why? Well, because we know from GE Vernova that's not currently an economic power source. Too expensive. So after taking a look at Great Lakes, I actually think it could be worth it for a trade, if not an investment. Company entered the year touting the strong federal support as a potential catalyst for its stock. While the talk is cheap, the company then followed up with a blowout quarter 1 month ago. We're talking about better than 25% revenue growth, 320% EBITDA growth, and a monster 24-cent earnings beat off a 7-cent basis. This is the second massive earnings beat in a row from Great Lakes. Oh, on top of that, the company has a healthy backlog. It started the year at $1.04 billion, and then it came down a tad to $879 million until the end of the latest quarter. That's still well above their 5-year average backlog of $623 million. Now, the stock did jump 24% in a single session after that last quarter. But it's not that expensive here. It's only trading at 12 times this year's earnings estimates. So you know what? You got my blessing to buy Great Lakes Dredge and Dock, although, again, only speculative, high risk, and you should probably think of it as a trade, not as investment, because who knows what's going to happen to all of these different projects once the federal infrastructure spending winds down. But still, this could be Great Lakes' moment. So I'm not going to discourage Matt in Massachusetts or anyone else who wants to buy that stock. I was very intrigued, and thank you for bringing it to my attention. All right, next up on Tuesday, Chris in Florida asked about Forward Air. Now, despite its name, Forward Air is not an airline. It's a provider of ground transportation-related services, primarily to the North American air freight and less-than-truckload market. Basically, it's a trucking company that specializes in taking cargoes from the airports to the final destinations. Forward Air is another company that's been around for a long time, came public over 3 decades ago, and for most of its existence, publicly traded company has been pretty good stock, climbing from the low single digits in the 90s to an all-time high of 125 and change in early 2022. After some sideways action in 2022 and in early 2023, the stock was still at $120 as recently as last summer. But over the past year, Forward Air shares have just collapsed, falling about 90% from peak to trough. 90! And by the way, the trough was just 2 weeks ago. Why the meltdown? Because Forward Air announced a disastrous deal last August, a cash and stock acquisition of a company called Omni Logistics. The deal was hated the minute it was announced, as people thought Forward Air was overpaying. Transaction added a lot of debt to the balance sheet, and everything else aside, these guys were doubling down on another logistics company in the middle of a freight recession. Within a few months, Forward Air and Omni Logistics were suing each other. Forward Air was trying to get out of the deal, even though they eventually went through it at a lower price in late January. How bad was it? Okay, look, even at the lower price, the acquisition valued Omni Logistics at $2.1 billion, okay? Just the company that they bought. But now the combined entity, barely above $500 million. Talk about value destruction. In the wake of the horribly conceived and executed transaction, Forward Air's then CEO Tom Schmidt stepped down, and then the CFO was forced out 3 weeks later. This is a horror show. But the stock's had a big bounce off its lows over the past couple of weeks, climbing from $11 and change on May 21st to $20 and change now. Why? Okay, first, stock caught a very smart upgrade by Wolfe Research, which took it from underweight to peer perform, basically saying enough is enough. They covered their short call, citing new management and potentially improving freight forwarding trends. Second, we've learned that there's an activist investor, one I've never heard of, called Irenic Capital Management, that they take a nearly 5% stake in Forward Air. According to the Wall Street Journal, these guys want a board shakeup and strategic review to consider putting the business up for sale. At the same time, a private equity firm called Clear Lake Capital recently disclosed that it's taking a 14% stake in Forward Air. Clearly, there's a lot of interest at these levels. I can understand being tempted to take a stab at this one. Now the private equity sharks are circling the business, but it's still not enough of a reason for me to recommend Forward Air. This one just seems like a total crapshoot to me. And the core story is just too messy for me to feel safe getting behind this one. Some good things could happen, but I just don't want to speculate. So bottom line, both of these teeny tiny stocks are very risky by nature, but I'd be willing to put a flyer bet on Great Lakes Dredging and Dock. I don't want to go near the disaster that is Forward Air. Mad Money's back after the break. It is time. It's time for the light round. Crazy Remember, where I take the calls. Rapid fire. You say the name of the stock. I tell you buy, sell, just regarding the calls. Stock questions. Time I step in for the way we plan to sell. And then the lightning round is over. Are you ready, Skinny Dad? Time for the light round. Crazy Remember, we'll start with Red in Florida. Red.
Hey, Mr. Cramer. How are you?
I am good, Red. What's shaking with you?
About 4 years ago, I heard you say on your show that you named your dog NVIDIA. And I thought to myself, you must be pretty darn impressed with this company that you named your dog NVIDIA after it. So I looked into the company and started buying into the beginning of 23 till I accumulated about 300 shares. Wow. God bless you and your dogs, NVIDIA 1 and 2.
Actually, I got to you are very kind. I got to tell you, I didn't mean to set the world up, but first of all, his name was Everest, and he was not answering me. But I called him NVIDIA, and he suddenly became a genius. And I will tell you this. I thank you so much. It's been a long week, and when I hear a call like that, I just get energized, and I'm ready for Monday right now. How can I help you?
Great. I just recently started a position in Schlumberger, ticker symbol SLB. And you're...
Okay, so here's the deal with SLB. It's international, and you really want domestic if you're going to do drilling, which is Halliburton. Schlumberger's got too much business that is not acting well right now. And I'm not going to recommend it here. I'm not, even though I like the company. Hey, let's go to Mo in New York. Mo.
Hey, Jim. Thank you for taking my call. Really appreciate it.
No problem.
I want to know, I was curious to hear what you think about the stock BlackBerry.
No, nothing there. I know people keep saying the software is something. Forget it. We want to go with really high quality. Go with T-Mobile if you want to go in that world. Let's go to Jim in California. Jim.
Hi, Jim. Thanks for taking my call.
Of course.
This company recently collaborated with Verizon and inked a deal with AT&T. What's your thoughts on ticker AST? TS.
I think it's had too big a move. I think everything you just said is in the stock, and now you got to worry about the earnings, of which there are none. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab.
Maybe good news is good news. All right, that's right. We added 272,000 new jobs last month, far more than anyone expected. So interest rates naturally soar, usually the kiss of death for stocks. And what happens? Stocks barely get hit. If you ask any Wall Street professional about what would happen today when that smoking hot number came out at 8:30 a.m., I'd tell you what they would say. I bet 90% of them would have said stocks are going to be down, maybe huge, especially ahead of next week's Fed meeting, I have to say. People are hoping for rate cuts in the Fed, but that is off the table when the job market's this strong, especially for like these next months that people keep saying, oh, they're going to cut. It's not going to happen. So why the heck then didn't the averages get crushed? I think it's because the Fed has kept us up pretty well. I think we're prepped and ready. We know that Jay Powell isn't expecting weak numbers. We know he hasn't said anything of late that would indicate that he's planning to cut rates anytime this year. I mean, people put words in his mouth, but I've listened. He doesn't. He's basically saying the data's the data. If the data's soft, he might be prompted to do something. But if the data's strong, don't expect any changes. As I indicated last night, Jay Powell is not trying to figure out how to get the stock market going. That's not his job. He's not trying to figure out how to sell more houses. There aren't a lot of houses to sell. He's not trying to put companies out of business either. He wants people to get a good job. A good job. But he also wants to preserve the working person's purchasing power because that's what takes the biggest hit from inflation, and that's what he's most fearful about. On Wall Street, we really tend to get caught up in ourselves. I was thinking about that during the kitty thing today. We really are very myopic. We keep thinking Powell must see that we need rate cuts. He, on the other hand, says we can't afford to have rate cuts because that could trigger massive hiring and massive wage inflation. If the Fed cuts rates and inflation comes roaring back, that's the end of their credibility. So what happens? I think Powell knows that you can't make a judgment on even the possibility of a rate cut until we get at least 3 weak job numbers in a row with little wage growth. After 3 soft readings, there might be some momentum to the downside that he can stop with a rate cut. Otherwise, he knows risks of setting off another inflation spiral are very real. Think of it like this. Inflation is cancer, and high interest rates are chemotherapy. The Fed won't cut down the chemo until they know that the cancer's in remission. That's smart. That's what we want. See, the problem that Powell faces is not the possibility of a hard landing like we talk about on Wall Street. This economy, even with a slowing GDP, can't seem to stop producing gigantic job growth. The problem is, as we saw from so many retailers these last few weeks, inflation is crushing the working people, the people that Wall Street tends not to think about. When Washington was sending out free money, that cushioned the damage from inflation, but not anymore. People have decided, for example, that the dollar stores are too expensive. The dollar stores. They've decided that $5 toys from Five Below aren't needed. They can go without the $9 burger, fries, and Diet Coke from a fast food chain. They're just fed up with higher prices. Hey, look, there's a reason why there are only 4 retailers that are doing well: Costco, Ollie's, TJX, and Walmart. They're offering prices that are well below what you can get from almost any other retailer, but they're not back down enough. Almost no one else, though, is offering any bargain proposition. Inflation, people, not economic weakness, is the issue. Until you see the cost of shelter and cars and insurance come down, there will be more pain. But like I've said many times, those costs won't come down as long as there's lots of hiring, like we saw this morning. So Jay Powell's inflation fighting days, they are not over. They're still very much on. The strategists calling for multiple rate cuts, they just don't get it.
They know nothing!
They've been wrong all year, and I bet they'll be wrong again. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday. Last call starts now.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.